with chaos at the New York Stock Exchange.
Get back in there at once and sell! Sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, February 13th, 2026. Oh, spooky day in the market, Friday the 13th. What's going on this week with the markets? What did the market do? It was down, okay, down. So market showing some weakness this week. Dow Jones down 1.2%, the S&P down 1.38%. And turning negative on the year, I might add. Now down 0.1% year to date on the S&P 500. The NASDAQ down 2.1%, also negative on the year, down 2.9%, almost 3% on the year for the NASDAQ. The Russell Small Cap Index actually being the strongest one, down 0.8% and still up 6.6% for the year. So Russell Small Cap Index still a little bit better. Volatility Index spiked up a little bit this week, up 16% at 20.6. That can certainly go higher. Looks like it wants to go higher. That could spell some trouble for the market. Here's something that's a little concerning. Long-term bonds as measured by the TLT up 2.5% in a week. Look, that's a big, big move for bonds. It kind of smells like fear, okay? That smells like fear. So you got bond values going up. You got the volatility index going up. These things could spell some trouble here for the S&P 500 in coming weeks. Looking at the different sectors, that's another thing that's kind of ringing some alarm bells, okay? For this week, we had consumer staples up 1.7. We had energy up 2. We had utilities, which are traditionally a safe haven, up 7.2% this week. Now, utilities are kind of interesting because they've also been moving with the AI trade. So it's like no matter which way you go here, utilities seem to be in a pretty good spot. If it's artificial intelligence growth, utilities are up. And if it's we're worried about the market, we're scared, utilities seem to want to go up. But interesting, defensives. Real estate up 3.5% this week, also traditionally defensive. Technology, on the other hand, down 1.1%. Consumer discretionary down 1.5%. So the defensive areas of the market continue to shine and shine brightly. I mean, look, year-to-date energy is up 21%. Consumer staples are up 15%. Utilities are up 9%. The S&P 500 is negative 0.1%. So we're seeing the defensive areas lead the way, and you got to watch out when that's happening, okay? I think I said last week, it kind of reminded me a little bit of the early days in the tech bubble when things started to unwind there. When it comes to gold and silver, gold up 1.5% and silver down 0.5%. So what moved markets this week? Well, I mentioned AI. There are a couple AI stories that rocked a couple of industries. Look, AI has just been taking turns, punching different industries right in the face. I mean, it hit banks a couple of weeks ago. It's been crushing software now for a couple of months. We talked about ServiceNow last week. This week, it was trucking and logistics and commercial real estate. So it's just taking turns, just punching different industries in the face, because that's how the market acts, right? And reacts, I should say. A headline comes out, says AI is going to take over, and the market just sells everything blindly. Okay, let's just get rid of everything here. Let's just sell it all, and then we'll decide if that was a good move or not, right? That's how the market likes to react, and we saw some of that play out this week. In addition to that, we got some geopolitical tensions arising. I think you could maybe say something in regards to oil going higher there with Iran and the U.S., some tensions escalating there, another aircraft carrier heading towards the Middle East, so that's something to be watching there. And then you've had earnings, and earnings have been really strong. They've been very, very, very strong, actually. We've seen some really good earnings numbers, and when the companies are hitting it, when they beat, when they raise, when they give a good outlook, the stocks are just taking off. Some stocks in our models, we had Vertiv. They provide cooling solutions for data centers. It was up 33% this week. We had Global Foundries. They make computer chips here in the U.S. That was up 18%. Shark Ninja up 14%. Some really big moves to the upside on some of these stocks. And then you've had other stocks like Cisco, great company, but they were down 9% this week with a earnings report that the market didn't like, just didn't care for the outlook. You had Pinterest. We talked about Pinterest last week. I started a position there because I thought there was potential for that stock to take off if the number was good. They did miss the number, missed it by a couple cents. But what I saw in the earnings report, I liked. I saw increased active daily users by a much larger margin than expected. I also saw a big increase in sales. But Pinterest took a big hit, down 16.8% today. And we actually took advantage of that and bought more. So we finished buying our position in Pinterest today. And look, I got to be honest with you folks, I was kind of hoping it would go down further. I wanted to buy more at a cheaper price. We got that opportunity today. I was just afraid it wasn't going to happen. That's why we bought it last week. So all that worked out great. My point here, though, is that the earnings have been good and stocks are reacting to those. If they're not so good, they're reacting pretty violently. If they are good, they're reacting pretty violently. So some big moves there on the earnings front. And earnings beats have been really, really strong as far as the percentage is concerned. So that's something I'm kind of watching, right? Are we hitting maybe a peak level there? This remains to be seen yet, but it's something that's on my mind. And then in addition to that, one other thing that's kind of got my attention right now is that the market's really broadening out, and everyone's been clamoring for that for a while. But you may recall in our 2026 outlook, I specifically said one of the things that we're being cautious about, that we're concerned about, is the end of peak concentration. Peak concentration. When you look at other historical times in the market, when the market has had extreme concentration in a very small group of stocks really driving the returns. And that's exactly what we've had now for a few years with the Mag 7 or the Great 8, whatever you want to call it. 7 or 8 stocks represent about 35 to 40% of the S&P and have really been responsible for the majority of the gains the last few years. Well, we've seen times like that in the past come to an end. The S&P 500 has performed very poorly, very, very poorly. Not all the time, but in many cases. So that is a little bit of a concern because these stocks are not doing well at all. We're seeing the market broaden out, which everyone was asking to have happen. Well, it's happening, but be careful what you wish for, folks, because when you look at history, sometimes things don't go so well. Speaking of all of that, there's some key levels on the S&P 500 right now. Look, you say, David, why do you always talk about the S&P 500? Why don't you ever talk about the Dow Jones? Because the Dow Jones is statistically irrelevant. I know it sounds exciting, 49,000, 50,000 on the Dow. And ever since you're a little kid, that's all you remember hearing about on the news, with Walter Cronkite and Dan Rather, the Dow Jones. Well, it's only 30 stocks. Okay, it's a very small sampling. It's really statistically irrelevant. The S&P 500, that is the heavy lifter. That's what we want to pay attention to because that's the broad market. And right now, it's moving down towards a level that I would call critical to some regard. 6750 on the S&P is the level that I'm watching. If it breaks down below that for a couple of days, I think we're heading down towards a 200-day moving average right now around 6,500 on the S&P. And then we'll see what happens when we get there. So I think the market's kind of set up to not look so good. We look at the DeMark indicators, another really good kind of like a timing type mechanism. Tom DeMark does great work. Everything looks stretched for the S&P 500 for the daily, for the weekly, and for the monthly. Other technical indicators, they don't look good. They just simply do not look good. And I don't have a lot of hope that the market's going to be very strong in the coming weeks. And you know what? That's okay because we are positioned for that, right? Look, we came into 2026 not trusting this market. I think I've been saying it every week that I don't trust it. I still don't trust it, and we're positioned that way. So let it go down, right? I'm fine with that. We have got a lot of defense. We've got a lot of positioning to try to give us some protection, some hedges. Even for our aggressive models, we've taken some money off the table there. So let it go down. That's fine with me. If it goes up, we'll be okay. If it goes down, I think we're positioned well to defend against it. And we can make some moves when the time is appropriate. So those are some of the things going on this week. Economic data was okay, surprisingly okay. We had a good CPI number. We had a good jobs number. So that was impressive. But other than that, market action just looks weak. So I'm going to wrap up between now and next week meetings. You're thinking about your future and long-term goals, all the things you want to do with you and your money. Maybe it is buy that second house, take that big trip, retire a little early. Hey, you know what your goals are. Don't just think about it. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.